Hi everyone, welcome back to Be Rich. Continuing our series of investing and how to invest, today we're going to talk about one of your favorite topics, which is equity versus bond. Should you be in the equity market or should you be in the bond market? Where should you be depending on your age and your situation is something all of you would be always wondering. So today I thought I'll ask Sashwath for his opinion about this. He's been what we call following Warren Buffett and his opinion on where you should be in the bond or equity market. So I thought he can offer us his insight about what Warren feels, and then Shashwat will take it further and tell us what you should do if you're in India. Okay, Shashwat. So what is this?
Yeah. So there's about you have two asset classes, very vastly different asset classes. But when it comes to investing, there are a few fundamental concepts that you want to look at. One, the return you're getting. Two, what your objective is with this investment. That is, what do you want to do with your money, and how is this asset class going to get you to that place? So when you look at the case for equity, what Warren Buffett said. So something Warren Buffett said in 2010 after the financial crisis was that he said stocks or equity, S&P 500 is the place to be, because he said that after the financial crisis there were depressed prices. He said there's going to the confidence with which these guys were buying and selling before has gone down tremendously. There was blood on the street, and prices were low. And Warren Buffett said now is the time to buy back during the great financial crisis or GFC. And then he advised people to say, you won't get these prices again. These are great prices, at very discount prices. Bonds are not the place to be right now. Stocks are definitely the place to be right now. And words of wisdom is what you can call them, because if you look at the S&P 500 after when he said that in October of 2010 to 2023 right now, the returns just in terms of the price increase has been over 10% year on year with the S&P 500. And if you had reinvested your dividends, you would have gotten 12.7% or so. So that is a phenomenal return in terms of the dollar. And now let's look at you if you were an Indian. If you were an Indian and you put money into the S&P 500 during 2010, which was still doable back then because the market had liberalized by then. So if you put some money into the S&P 500, not only would you have seen the S&P 500 give you 10% in terms of, or 12% in terms of the US dollar. In terms of the INR, how much ever the INR is depreciated from 2010 till 2023, which has been a tremendous amount, you would have seen windfall gains, and you would have seen amazing returns which the Nifty might not have been able to give you. So this is what Warren Buffett said, and time and time again, Warren Buffett has been proven right. And if you had bought Berkshire Hathaway Class A stock in 2010 and held it till 2023, only that alone would have given you 10% compounded annually from that period. So this is something to think about. But it's not a black and white situation, it's a gradient. Now let's look at bonds. If you had bought bonds during the 2010 financial, when you were still reeling in from the financial crisis, what you would have seen was that US treasuries would have given you negative real returns because the interest rate was very low, almost zero, and you had your treasury securities not giving you anything, and your 10-year yield was giving you maybe 1 point something percent return. That's not much to write home about. And if you had compounded that over the period of 10 years, because from 2010 to 2020 to 2020 and then 2023, what you would have seen is that your interest rate never actually went up. And very recently, yes, it went up, but before that, you would have compounded at a rate of 1 or 2%, which isn't much at all when your inflation rate is standing above that. So you stand to make nothing in terms of bonds. So your money is at best stayed stagnant, at worst eroded due to inflation. So this is why the great Warren Buffett is something not to be written off, because he keeps giving you words of wisdom. Even though he's too big to be able to follow his own advice, his advice for retail investors like us makes a lot of sense. And even now, it makes prudent sense for us to SIP away and buy the Nifty. If the S&P 500 is not something within your reach, buying the Nifty is not a bad idea at all. And regardless of what political party, regardless of what natural disaster and what economic policies occur, India is resilient, has been resilient, and will be resilient. So if you want to make some returns and you want to buy equity, India is a great place to be. Only because India is a country which has been very resilient. We've been there for over 70 years and we'll continue being there. So buying the Nifty is like buying a portion of India. And you can cash in on the returns which Warren Buffett talked about with equities. Equity is a wealth builder. Bonds are a wealth preserver, not a wealth builder. But that is the case for US markets. What do you think about the Indian market?
Indian market is exactly the opposite, because the problem in Indian market is there's been stagnation in the stock market. As far as stock market prices have gone, if you see from, except for the dip which happened during the COVID dip,
Yeah.
if you really look at it, it's been pretty stagnant and been pretty flat, the growth.
Yes.
There are individual companies in individual sectors which have done well, but overall the index, if you see,
Yeah.
it's not really something to be cheering about.
Yes.
It's not gone down, but nor has it really gone any stellar place.
Yeah.
And the bond, meanwhile, has given consistent and interest rate which is beating the inflation, Indian
A
inflation.
positive real return.
Yeah.
Yeah.
So in India, the case is different. If Warren Uncle was sitting in India and he is an Indian investor, his writing home letter would be probably slightly different.
Yes.
He would probably tell you to keep your money in bond because it is offering better returns for the time being.
Yeah.
Warren is always loves playing in equity,
Yes.
and that too buying specific shares in specific companies and hitting and trying to get good returns on those sectors. Always saying stay in your circle of competence.
Yeah.
But here, even in being in your circle of competence, the returns would have been not so great.
Abysmal.
Yeah. So in India, the equation is different.
Yeah.
Flipped. So this goes to saying always what Anand says and everybody says, investors, advisors say is, when you look at investing, don't go through your heart, don't go on your opinion, don't go on your political lineage or whatever it is. Be thinking with actually your mind and not with your heart.
Yes. As rational as possible.
As rational as possible. Like Nassim Taleb says, all of these people say, be rational as much as you can and don't get carried away with your emotions.
Yes.
See where your returns are stable, secure, and it makes sense against inflation. The biggest and only guy who can destroy your asset class, who can destroy your return, is inflation. Nothing destroys anything like inflation. So if you're always ahead of your inflation, your growth is always assured. You may not have growth compared to your friend or somebody else, but don't worry about that. Focus on your returns. As long as you're beating inflation and you're consistently beating inflation, those ones and twos, as they say in cricket, are far more important to getting to your 100 than the fours and six. Fours and six will not get you consistent centuries. What get you centuries are the ones and twos. So make sure you keep running between the wickets and collecting those ones and twos. And before you know it, your run rate will creep up and you will be getting your centuries consistently.
Yes. And we're very often asked, this political party has come, that political party has come, the elections are coming, this mandate is going to be passed. What do you think about all this? What will happen to the stock market? I've very recently been asked myself, saying that what will happen in 2024? What do you think if this party comes, that party comes? What discount that? All that is secondary. What you have to understand about investing and equity and the Indian growth story is that yes, you may have bad years, you may have good years, but India as a country has been here before you were and will be here after you are. So what you have to understand is that you're making a bet on India. You're not making a bet on one party or making a bet on the other party. If you are SIPing, if you are indexing, and you are being financially prudent by saving and not borrowing, you are betting on India and you are betting on yourself. So that is as far as I'll take it, because if you think that India is going to do well, then you should definitely be SIPing. If you think you are financially prudent, then you should definitely be SIPing.
Yes, what Shashwat is saying is very true. All these are short-term uses, short-term blips, and all our investment advisors and gurus have always said this, including Warren Buffett, Peter Lynch. You take the whole gamut of them. They say, do not look at the news too much. Do not worry about all these ups and downs in the stock market. Don't get carried away with all what your friends are saying, what people are saying. You focus on whatever you know, your circle of competence. Do your research. After you do your research, place your bets and then look for the long-term return. Track your companies once a year, once in 6 months. Look at what's happening with your investments. Track them and make sure you're beating your expected returns. Whatever you think your returns should be, if you're achieving that or going more than that, that's more than enough.
And have very reasonable expectations as well.
Yeah, and steer away from all the rest of the news and all the social media, whatever is happening, and try and focus on other things. If you must consume news which are not related to finance. If you must consume social media which has nothing to do with investment and finance.
Yes.
That way, you'll keep your mind and your heart away from constant fluctuations. And don't log on and keep on checking your portfolio every other
2 seconds.
minute,
Yeah.
or even once a day. Don't check your portfolio, or even once a week. It's like trying to lose weight and constantly, every time you walk past the weighing scale, standing on top of it and trying to see if I lost any weight, lost any
A
weight.
lot of noise in the short term.
Correct. All lead is frustration, because you'll be constantly looking 1 rupee up, 2 rupee down, like that. So don't do that. Once in a while, keep it, put it in a calendar. On my birthday, I'll invest, or I'll check on my birthday or something. Whatever works for you. Set up a calendar like that, so it keeps you away from your portfolio for long periods as well, so you can see those returns.
And we'll definitely make a video on tips which you can enforce and habits which you can put up so that you are able to enforce these ideas which he's talking about, such as not checking it and having financial prudence.
And to conclude this video, when it comes to the question of equity and bond, both are very great instruments of investment. What you have to make sure is you have to see where the cycle is. Depending on where the cycle in the Indian situation, or the Indian market, or the American market, wherever you plan to invest is in, you should place your coins accordingly and move so that you catch the waves as they come up, and you get off the wave when it's on the top, and you catch the next one at the bottom so you can climb back up. This way of rotating your money through different cycles will definitely ensure very good returns and growth for you. Another thing which we want to do is we would like to do a Q&A video starting every weekend with you guys. So your questions, we will try and answer them to our best of our ability. Please put in your questions down below in the comment sections. We will collect all your questions over the week and try to answer them during our weekly Q&A videos, which we plan to launch coming shortly.
And please avoid stock specific questions because we are not SEBI registered advisors and we
Yes.
won't be able to give you the guidance that you require.
Yes, please do not ask us on specific companies, specific stocks. Should you be buying them? Should you be selling them? What do you think our opinion is? We cannot offer those to you. We are not SEBI registered investors, and we don't claim to be, nor are we asking you to buy specific shares in company. If you have any other questions, please do ask them, and we're more than happy to answer them. Thank you again for watching our video today. If you like our content, please think about subscribing to our channel and turning on the bell notification so you'll be notified every time we put up new content. And if this is something you think your friends and your family would like, please do share our videos with them. We'd like to thank you again for joining us today on Be Rich.
Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.